Ever wonder why some investors brag about their tax refund while others moan about audits? Well, let's dive into two real world short term rental stories to see what works and what breaks. Hey everyone, this is Sammy Basta CPA. I'm your friendly real estate accountant. And grab a coffee, and we're about to learn from two different journeys here today. We will start with the win. So, meet Sarah. Sarah is a nurse who hated seeing half of her paycheck vanish to taxes. So, she read about short term rentals and decided to buy a small beach house. So Sarah bought a $400,000 property with 80,000 down. It wasn't easy, but she saw the potentials, so she decided to do it. Sarah made sure the average guest stay was under 7 days according to the short-term rental rules, so the property would qualify as a business rather than passive rental. Also, instead of handing the key to a property management company, she rolled her sleeves and she handled everything from booking, coordinating cleaners, answered guest questions, all the hours. So she was totally materially participating and involved in her business. And because she did that and followed the rules, so she was able to use the losses from the rental to offset her W 2 income. So it wasn't a passive hobby, it was a business. In addition to that, she hired a cost segregation specialist. They figured out about 20% of her purchase price, around $80,000, was a write off right away in the first year. So at her tax bracket, that deduction saved her about $20,000 in taxes. And that was a nice chunk of money goes to her pocket. Now, instead of blowing that refund on a new car or shiny object, she rolled it into another rental. So one smart move turned into two properties, proving that how tax strategies fuel growth. And that's what I want to show you from that case study, that tax code isn't just a set of rules, it's a roadmap. You follow it and you can fuel your growth instead of paying Uncle Sam more than what you have to. Okay, now we're gonna take a look at a different journey. Now let's take a look at Mike. Mike is an investor, and you can see what happened when you skip the fine print. So Mike also bought a beautiful cabin. It was his dream getaway, and he planned to rent it out when he wasn't using it. So that sounds great. So Mike stayed there for weekends, holidays, and long summers. He allows his friends to stay for free, so he didn't track his days or hours. And you see, that's the big problem here because the IRS counts your personal days, and the free and discounted stays you give to your friends and family. So just remember what's the IRS rule. So if you use your rental for more than 14 days or 10 days of the days it's rented, the property is considered a personal property, non-investment property. But Mike went way over. He didn't even keep logs. So when he tried to deduct expenses, the IRS disallowed them. So all the rental losses were thrown out. To make matters worse, he hired a property management company, so he didn't do much himself. And because he didn't materially participate and he wasn't materially involved, he couldn't take advantage of the short term rental loophole. So the home became a costly vacation house instead of a tax efficient investment. So, yeah, he still enjoys it, but his tax bill is painful. So you can see what happened with Mike here, and that will teach us like you really need to follow the rules. So you need to treat your rental like a business. Track your days, limit personal use, and follow the rules to get the tax deduction. The takeaway here is short-term rentals can be powerful wealth building tool when you understand the rules. You treat it casually and you learn the hard way. Remember, material participation is the key, and that's what the artist is looking for. So you keep the average 7 days or less, average guest stay, put in the work or hire help, but you still have to log in at least 100 hours or more than anybody else to prove that you materially participate if you want the tax deductions. Also, keep personal use to the greater of 14 days or 10% of the days rented. Don't give away any free stays unless you're ready to lose deductions. And if you want to save big, you want to hire a cost segregation specialist to accelerate depreciation and save big. But the most important thing here is documentation. So you need to document everything, because if it isn't written down, it didn't happen. Hey, I hope that was helpful. I want to thank you very much for watching. If you find this is helpful and useful, hit subscribe so you can catch the next episode, because I want to show you the next one, how to finance your short-term rental. So you'll keep avoid more hard lessons and build your own success story. Thank you.
This has been another episode of our tax saving video series. If you enjoyed this video, please like it, subscribe below, and share with other business owners. You can find previous episodes and more information at www.bastacpa.com. Thanks for listening, and have a great day.